Have you ever wondered what your bank account would look like if you just put down that $100 weekly instead of splurging on those suspiciously expensive lattes? Well, brace yourself because we're about to crunch the numbers and see what would have happened if you had consistently invested $100 per week into the S&P 500 over the last 20 years. Spoiler alert, you might want to sit down for this. Now, before you start regretting all those impulse buys, looking at you inflatable hot tub, let's break it down. Historically, the S&P 500 has averaged around a 10% annual return. But inflation, that sneaky little thief, eats into your gains, bringing your real returns closer to 7%. Still, not too shabby. Let's pretend it's 2005. Low-rise jeans are somehow still in style, and you decide to make a smart money move. Every week, you toss $100 into the market. Even with the financial chaos of the 2008 crash, the pandemic meltdown of 2020, and enough market drama to rival a reality TV show, your portfolio would be worth approximately $384,000 before adjusting for inflation. After accounting for inflation, you'd be looking at a cool $213,000 in today's dollars. Not bad for a hands-off approach that required zero stock-picking wizardry. Of course, this isn't just about the numbers. The hardest part? Not freaking out when the market throws a tantrum. Remember 2008? The S&P 500 dropped over 50 and people were hoarding canned beans like the apocalypse was imminent. Then came the pandemic plunge of 2020, which was like watching a roller coaster drop with no guarantee it'd climb back up. Yet those who held on, resisted panic selling, and kept their money in the game saw their portfolios bounce back like a cat with 9 lives. But hey, maybe $100 per week sounds like a lot. Fair point. That's about $5,200 a year, which is less than 10% of the median US salary. Think of it as skipping a few overpriced brunches or resisting the urge to buy every shiny gadget that TikTok swears will change your life. Sure, there are skeptics, but what if the market crashes again? They cry. Well, spoiler alert, it probably will. And then it'll recover, and then it might crash again. That's the market's version of cardio. The real challenge isn't avoiding downturns. It's staying invested through them. Just ask anyone who panic sold in 2008. Ouch. So next time you're tempted to splurge on something questionable, I'm talking to you air fryer ice cream machine enthusiasts, consider what consistent investing could do instead. After all, wouldn't it be nice to open your portfolio in 20 years and say, wow, I'm glad I didn't spend all that money on novelty socks? But hey, here's a thought to leave you with. What if you started now? What would future you think about that decision? And more importantly, will future you still be wearing low-rise jeans? Food for thought.